The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
You almost said the radio there.
Maybe that's where I was going. All of a sudden, I was like, I don't know what I'm saying. I don't know what.
Anyway, after 14 years on the radio, doing the podcast is a different gig. But so it's a little bit different job for us. We're going to talk about jobs anyway today. Job growth reports came in way above expectations last week.
Very
the expectation was for about 173,000. It came in almost 200,000 higher, and the market didn't really know what to do at the onset. So at the open, it was down, and then Mr. Market must have thought, "Hey, people are working. That ain't so bad." And the market turned around. At least the indexes. We should be real clear here.
Correct.
The indexes turned around. But that masks what's really going on in the market. Part of that is we turn around and look at this data for the jobs number, that 336,000 jobs. That sounds like that's really good. Business is booming. Well, it's business booming for the government because 1/3 of those new hires are government employees. Guess what they make? Regulations. They don't make
more
anything
and more
productive.
It's not productive. That's the main thing. That's right. Those government jobs, and you hate in a capitalist society, you hate for the government, the state of any kind, to be one of the largest or the largest employer. That's never a good sign of economic health.
Well, they're also not necessarily the highest paid in the system in
True.
economy. Another third are in the service business. Well, that means hotels and restaurants. Those are in the same category of payroll. It's the lower quartile. These are not highly
Correct.
compensated people. So yes, we had some job growth, but it wasn't the kind of job growth that you associate with the Reagan post Jimmy Carter era or the 1990s. When we were developing our inroads into the internet, or the first decade of the millennium, those were much more productive periods, and service people benefited, but they're not the drivers of the economy. And a lot of those service people,
Yeah,
a lot of those service people are college educated with advanced degrees and student debt to pay because they have degrees in jobs that pretty much are hard to find.
right on.
But along with the 336,000 new jobs, the July and the August numbers were revised upward. So that's generally good. But then a lot of people are in the gig economy. They've got a side hustle, if you will. So there's 8.5 million people who are multiple job holders. And each one of those jobs they have gets counted as a new job in the government scheme of things. So all of that excitement that looked pretty good does have a little bit of caution that needs to be.
Especially that gig economy, because number one, that's still pretty new for our economy, and somebody may have 2 or 3 different gigs, so to speak, and so instead of having that being 2 or 3 separate jobs, that's one job. That's supporting one household. And so those numbers don't mean exactly the same thing they used to. It's just another evolution in the data stream that we need to get a little more adjusted to as to what exactly does that mean.
Well, and all that employment must mean that the economy is doing fairly well. We're chugging along.
There you go.
We're not racing, but we are continuing to move forward. That's generally a positive. And so while the market initially tanked, interest rates went up. The 10-year interest rate pushed just shy of 5% before it settled down at the end of the day. But the 30-year Treasury bond moved to 5.3%. You haven't seen a 30-year Treasury bond at that level in more than a decade. It's been a long
Yep.
time that we've had to deal with that. However, from an interest rate standpoint, historically speaking, we're pretty much in the normal range. So the fear that the economy is going to collapse because of interest rates are where they are means we have to adjust to a new reality, but we're adjusting back to periods of time that the younger generations, and that would be Gen X and the millennials and the Y and the Z and whatever else comes after them, they never saw this. As
Right.
boomers, I mean, we grew up with high inflation and high interest rates.
High interest rates. 5% feels pretty good. 5% and long term is like, hey, that's not bad. At least it's not double digit interest rates anymore. So it's that frame you can put on it and say, well, yeah, that they're higher than they just were. But for if you take a step back and take a look from 40,000 feet, it's not that high, and it's not enough certainly to alter the direction of an economy. It's hopefully enough to, as far as the Fed's concerned, to put a damper on inflation. But the Fed's desperately trying to dampen inflation and leave the economy alone, and to the best that they can. And 5%, that may be kind of in the range where that may happen.
It's possible. It also pushed up mortgage rates to 8.5%. And we're
Right.
thinking, oh my goodness, 8.5%. Who can afford a mortgage at 8.5? But on the radio, I told this story over a number of years. Back in the early 80s, I had a client call and say, I just got approved for a house. We got the deal accepted. The mortgage is approved, and I'm going to have to make a decision whether they're going to close. I said, so what's your problem? He says, it's the mortgage. Well, you qualified, right? He says, yeah, but it's 21.5%.
How about that? 21 and
21.5%.
a half.
I said, well, you have the job, you have qualified, you've got the family, you have the need, you can afford it. It looks like that's the deal. And so he went ahead and bought it. And I don't know, if it probably wasn't a variable rate mortgage. I don't remember how popular variable or common variable rates were in the early 80s. By
Probably not
mid to
very.
late 80s, they were. But if he'd be able to refinance periodically and cut his interest expense and his mortgage rate, I mean, that worked. A variable rate would have done the same thing for him. But I've read an interesting article, which isn't associated with the jobs issue, but with regard to housing and
Yep.
housing deals that are being done. People are getting really creative on their alternative financing, and builders are willing to work with them on that. It's not straight line bank mortgage lending. They're getting private
Yeah.
parties, private lenders involved. They're finding ways to make this stuff work. But from the Fed standpoint, you just mentioned the Fed trying not to mess with the economy. The real concern is if you have full employment and the economy's growing, that pushes inflation higher. That makes the
Correct.
Fed's job more difficult. And that increased the number of comments from various federal bank governors that interest rates are going to be higher for longer. And there's probably some more rate hikes coming. What what Chairman Powell wants to see is higher unemployment numbers, and
Yep.
those aren't happening. That's just
He's
not.
not getting what he's wanted, and that's just like you said, Don. That's why they are saying rates are going to be higher for longer. And they also came out and said, and when we begin cutting, we're going to be cutting rates much more slowly. They're going to go really carefully on the downside, which we didn't get to yet, by the way. And so some of that's already being priced in by the market, and it's like probably out over their skis a little bit there, a little ahead of schedule, because the Fed's not done raising yet, if you take them at their word. And with that jobs report coming in so hot, they may feel like they're going to be required to make at least one more bump upward in the interest rates.
Well, in the fixed income option market, where they basically are placing bets on the futures and where rates are going to be, since Friday, the probability of another rate hike this year has increased from 40 to 50%. So it's still a coin toss. But
Sure.
from my perspective, I think it's pretty likely that we're going to see another rate hike this year, and we could well see one or two more next year, unless there's real disruption, which, given Hamas and the Israeli that happened over this weekend, that
Here's a
could
big one.
expand, and that could change things globally. But right now,
Definitely. Yep.
that's too early to call that particular. So I mentioned the market response on Friday, and
Yep.
we saw the indexes go up. So we do a lot of charting work, and we use candlesticks. So they're, depending on whether you color them or not, they were positive, they were higher, and they moved off of the lower support levels. But when you look underneath the hood, so to speak, it was really driven by the Magnificent Seven again. It
Hmm.
wasn't a broad market rally, it was confined to the large cap stocks. So the mutual funds and dark pools were supporting the appearance of a healthy market that was rejuvenating itself. And that's not the whole story.
Not necessarily the case across the board. There's plenty of weakness out there. There are plenty of individual securities that are not doing well already, and especially on the tech side, tech is especially sensitive to those interest rate hikes due to the fact that they pay no dividends and they finance their expansions through borrowing. So if you're smaller and you don't have a huge bankroll to deal with, it's going to be much tougher for you to grow your business, and that's being reflected in the broader numbers, but not necessarily in the Magnificent Seven. Those huge mega cap tech stocks are still driving the indices higher, but boy, underneath that, there's a lot of weakness still to be accounted for.
And that weakness is very likely to continue because of
Sure.
rising interest rates. And part of the argument is, well, the economy's strong, we're getting by, the Fed's not going to have to raise rates very aggressively or maybe at all. We'll have a soft landing. But I would argue that with the spending that the Congress is doing, the expanding programs, more and more programs, the
Right.
higher cost of interest to fund the current federal debt, and the fact that the Treasury has to issue another $1 trillion of debt this quarter. No
Right.
forecast has been made for next quarter, but they did $1 trillion last quarter. They're going to do $1 trillion this quarter. You want to bet on next quarter?
Yeah. Somebody take a wild guess. Yeah.
A round number of about $1 trillion. So,
Coming
okay, so
again. Yep.
somebody's going to buy that. Well, there have been buyers for that for the last decade and a half. It's not been a problem to just continue to fund deficit spending. But the Federal Reserve Bank was a major buyer of those bonds to support the market and business. They no longer are. They're selling their
They're out.
bonds,
Yep.
and they're losing money on the bonds they did buy. If they were a commercial bank, they would be looking for a bailout savior, just like Silicon Valley Bank and the other two did back in March. The Federal
Yep.
Reserve Bank is upside down on the balance sheet. They can't be an active buyer unless they're going to accelerate inflation. Who are the other buyers? Well, one of the other major buyers is China. Guess what China's not doing? They're not buying our bonds either, and they've been offloading them. So we still need to sell $1 trillion worth of treasuries. How do you make them attractive? Lower prices, which mean higher yield. Well, what actually
Higher
the
yields.
bond market does is they say, well, you won't buy them at 5%. Will you buy them at 6? You won't buy them at 6. How about 7? 7 going 7.5. Anybody take 7.5? It's 7.75. 8. Anybody? You got an 8. I'll take your money right there. And so what do you have? You have higher interest rates for longer that the Fed didn't have to do because the Fed's not buying. Eventually, that will turn the economy lower and the unemployment rate
Has
will
to.
rise. And the Fed will then say, well, we're done raising rates and we'll
We
start
made it.
cutting
Yep.
ourselves. Yeah.
Yeah.
They will raise their hand and say, aren't you guys going to give us a round of applause? Hey, look what we
We
did
did
for
it.
you. We
Yeah.
we collapsed your economy. Aren't you happy?
As planned. Right.
Yeah. So that's kind of the good news and bad news scenario for full employment because it raises inflation. Um, that's the bad news part. Anyway, Barry, I think that's a wrap for today.
We're good. Yep.